Hey, everybody. With us again is Mark Collinsworth of Vere Global Wealth Management. And the big topic today is the Federal Reserve released its minutes from the last meeting where they raised interest rates. And what those meetings reveal could affect where the market is going. And the details are very interesting, what they're saying about where they go from here with interest rates, et cetera. So, Mark, take it from there.
Thank you, Larry. So basically, the minutes are basically the official notes from the Federal Reserve meeting that they had from 2 weeks ago. And when the minutes came out today, it basically said, they're still looking at doing 50 basis points. They talked about increasing their quantitative tightening program. And basically what that is, over the last 2 years, the Federal Reserve has been buying bonds to add more money to the banking system. And starting next month, they're going to start selling those bonds back in the market and accelerate those selling going into the late summer.
Okay, Mark, just a refresher here. Now, they met in May, and that's when they raised interest rates half a percentage point or 50 basis points. And a number of people were surprised about that. But the big question that hung in the air after that decision was whether they'll keep raising interest rates by that much in a series of rate increases, or whether it would level off. So the meetings reveal that they are thinking now of a series of half percentage point interest rate increases, correct?
Correct. And that's something that was revealed in the notes today. Was everybody on the Federal Reserve Board agreed to do 50 basis points, and almost everyone on the board is looking at doing another 50 basis points after the June meeting.
Now, their May decision to increase at 50 basis points or half a percent, that in itself was hadn't happened in a number of years, correct?
Correct. That has not happened. You have to go back before the housing bubble to see a 50 basis point increase at a meeting.
So that seemed radical to a lot of people back then in May, just a month ago. And now they're telegraphing that there are probably more of those steep rate increases ahead. Now, how did the market react on that news?
The market actually rallied up on that, and I think the reason why it rallied was because everyone was already anticipating a really bad release of the minutes. A lot of people have been speculating 75 basis points may have been discussed at the meeting, even 100 basis points. And because the minutes did not reveal anything about 75 basis points or 100 basis points, the market kind of viewed that like, whoosh, we missed another time bomb.
Well, let's explain to people who are listening who are not familiar with how it works with interest rates and how significant a half a percent or 50 basis points, how significant that is on affecting the economy, mortgages, lending, and all other. I mean, to a lot of people, it seems like, that's not a big deal, just a half percentage point. So, but, what effect does that have?
Well, it adds up over time. So to give you an example, when the Federal Reserve raises 50 basis points, all of your banks start raising their rates. So all the things that you go to get a car loan, mortgages, personal loans, that's all based off the decision of the Federal Reserve. So let's give an example on your credit card. So based on how credit card cycles work, when the Fed raised interest rates in May by 50 basis points, you'll see that on your credit card statement, but they will not raise the rate on your credit card until a full billing cycle. So you won't see your credit card go up for another 31 days.
So will the interest rate be just a half percentage point higher?
Yes, and in some cases, because it's the bank that is setting the interest rate on your credit card, just because the Federal Reserve does 50, that there's nothing stopping the bank or the credit card company from raising at 75 or 100 basis points at their level.
Well, that's what I'm asking. I mean, so when the Fed raises at 50 basis points or a half a percent, the actual increase in the rate of interest on your credit card could be significantly higher.
That is correct.
So therefore, aren't a number of people getting nervous where this is going, since they've said they'll be raising it a number of times in the months ahead, 50 basis point at a clip? I mean, I don't see how that isn't having a drastic effect on the market, or if not today, fairly soon.
Well, it kind of is. The market's been selling off all year in anticipation of these rate increases. But the problem is they're going to keep on raising more. So the sell-off we've seen in the market has already priced in everything so far. Going from this point forward, the stock market is going to probably stabilize. And if more bad news comes out from the Federal Reserve, it'll start selling off again, which I anticipate it to do in the late summer.
Okay, well, talking about how much power the Federal Reserve has and the number of techniques they use, a lot of this also combined with the half percentage interest rate increase at the next meeting in June anticipated. They're also talking about reducing their red ink by selling off mortgage-based securities and bonds. Now, how does that work?
Okay, so when the Fed does what's called a quantitative easing program, that's where they go and actually buy treasury bonds and mortgages. So at banks, let's say we'll use JP Morgan, for example. If JP Morgan has $500 billion in bonds, there's not a lot JP Morgan can do with that $500 billion. They can't loan it out for mortgages or car loans. But when the Federal Reserve says, hey, we're going to buy that $500 billion of bonds from you, that basically infuses JP Morgan with $500 billion after they sell the bonds to the Fed. And that $500 billion can be used for mortgages, for loans. It's money that can be used to stimulate the economy by consumers borrowing that money from JP Morgan.
All right, and here's an interesting factor. Where does the Federal Reserve get the money, that vast amount of money with those bonds?
Well, funny that you should ask. They did an interview with Jeremy Powell last year on 60 Minutes, and we should get that clip to actually show what the reporter said. So you guys are buying bonds? He said, yes, we are. He says, so where do you get the money for that? Where do you get the money to buy those bonds with? And he said it with a straight face. We print the money. And the guy asked him, yes, so you print the money? He said, yes, we print it.
So there you go. That's the way it works.
That's the way it works.
Right?
Yeah, what's the problem?
Actually, what is the problem with that? I mean, since it seems to work, are there long range consequences if they keep doing that?
There is, because at some point you have so many dollars out there in the system that eventually the dollar, supply and demand, the dollar starts to come down. And if the dollar starts to come down, that creates its own inflationary problem on its own.
So again, Mark, where are we headed with this now? You say the market actually went up today. You don't expect any immediate drastic effect. Well, how about the months ahead? With the other rate, 50 basis point, half percentage increases in a serial way, one after the other.
Well, I'll kind of give you a little background on this. The Federal Reserve, where they make their mistake at, is when they raise interest rates, it actually takes a few months for that rate hike to actually work its way into the economy. So the rate hike they did actually in March, you won't really see that start to affect the economy until probably this month, maybe next month. So they keep on raising the rates one after another, but it still takes several months for it to actually take effect. That's problem number one. Problem number two is the inflation scenario is already taking money out of the economy. People are spending more money. So if you had money to spend on buying, let's say, a new car, well, you may have to end up spending that extra money on higher gas prices, higher food prices, and so forth, and you're not able to buy that car. So the inflation rate actually pulls money away from the economy on top of the Fed. So it's actually hitting the economy twice. And that's where I think the Fed's making their policy mistake.
Because actually they said that in those minutes that they're going to move away from a neutral position and go into something more aggressive, and actually they termed it restrictive. So that means now they're getting more aggressive about restricting the economy to lower inflation, correct?
Correct. And where the real key point, and I think what the market's kind of missing for the rest of this year, is the Fed likes to use a thing. Most people like to refer to the CPI, Consumer Price Index, for inflation. The Federal Reserve likes to look at what's called the PCE, which is the personal consumption expenditures. Basically what that number does, like in the CPI, if the CPI has Coca-Cola in it and the price of Coke goes up, that's inflationary. The PCE measures, well, if you stop buying Coke, what are you buying in its replacement? Are you buying Pepsi, Dr. Pepper, water, or so forth? So the Fed likes to look at the PCE. And the reason why I bring that up is the Federal Reserve today in their notes released, they think the 12 month going forward over the next 12 months, the PCE is going to average about 6% inflation. Well, what that means is if they want to get to a neutral rate or a more aggressive rate, that means they have to raise the Fed funds rate above 6%. And I think if you raise interest rates of the Fed funds rate above 4%, I think you'll have one doozy of a recession on your hands.
So when we spoke the last time last month, you thought that we are in a recession now in some sense, and it's probably going to get worse, correct?
Correct. So right now, I think we're in I'm going to call it a mild recession. If people that remember the 1990 recession, it was a recession by definition, but it wasn't that bad. I think that's kind of the recession that we are right now starting to enter. And if the Fed keeps on raising interest rates, I think it will push us into a much dire recession.
So for those who have stocks, what should they do?
Well, if you own stocks, it depends on what stocks you own. In a rising interest rate environment, and especially with rising inflation, the last stocks you want to own is technology stocks. And I know people love tech. They think the future's tech. Well, great. Back in 2000 with the dot-com bubble and the internet, everyone thought the internet was the future. Well, guess what? Most of those companies dropped 70 to 80%. So be really careful with your tech. But healthcare stocks, consumer staple stocks, especially with the war in Ukraine, with defense spending, weapons manufacturers are fantastic places to be at.
You said the last time we talked in May when they raised the interest rates a half percentage point, that you think it'll start turning around probably in October of this year, because why?
Well, for several reasons. One is usually when the Fed starts raising interest rates, it's kind of you can call it almost a timeline. Once they start raising rates, they usually stop at about 9 months to 12 months out. So we have the elections coming up. We'll be pushing fairly close to the 9-month window. And not to mention, we actually had one of the Federal Reserve governors actually made a comment today, Bullard, who actually said if we can get inflation under control, we'll actually start cutting interest rates next year, which I think also helped the stock market rally up a little bit.
Yeah. So, of course, the Biden administration keeps blaming everybody else but them for what's going on with the economy and inflation. Now, the last time you said, it really has nothing to do with Putin's price hikes and war.
Correct.
It started way before then, or at least sometime before then. Do you still feel the same way that the driving force here is the government spending we've had since actually the last couple of years, but especially since Biden took office? So do you still think that's the primary driver of inflation?
Well, yes, the inflation is actually coming in here from three places. One, from all the government spending. It was a lot of government spending that didn't really need to be done the way that it was done. The Federal Reserve pumped a whole lot of money into the system really fast. They really overdid it. And then third, the Biden administration has just declared all-out war on the energy sector with cutting, the pipelines, cutting leases. And what infuriates me is you have the press secretary for the White House gets up here and says, but we've issued all these permits and the oil companies don't want to take advantage of these permits to drill oil, and they're the ones that are raising the prices on the American people and not the White House. But the press secretary fails to mention this, but the CEOs of the oil companies are definitely mentioning it. But you barred us from drilling on federal land. So the permits that you gave us are for federal lands. That's basically like if I give you a free pass to drive your car as fast as you can, but I tell you, hey, I'm going to take your car away from you, but here's your permit to speed as fast as you can. Go out and drive as fast as you can, but you have no car. And that's exactly what the White House has done, trying to blame it on somebody else, but creates the problem in-house.
So it's really a trick here that they're playing.
Yeah, that's just a bunch of lies, just lies after lies.
All right. Now, is there any logic at all to the argument that not just oil companies, but companies in general are taking advantage of this perceived crisis and therefore unnecessarily raising their prices? In other words, price gouging, which Biden has referred to several times. Any validity to that?
Well, let's think about this. So the pipeline they were planning on building, the pipeline from Canada into the United States, it was going to go through a pipeline, right? Once this gets built, there's almost no cost whatsoever to it. You're drilling oil right here, basically in your own backyard. But now, because demand has gone up, you know how you get your oil now? You have to buy it from Saudi Arabia. You have to put it on one of these gigantic oil tankers. that burns up God knows how much oil just to go from Saudi Arabia across the Atlantic Ocean to here. And that's a cost. You're paying additional cost to bring oil from the other side of the world over here. And companies have to increase prices on the consumers because you're not buying US oil from your backyard. You're buying oil from on the other side of the world. And there's a cost to move it from point A to point B.
So what you're saying is that this is largely legitimate in terms of price hikes, that companies are not really taking advantage of the situation to unnecessarily and artificially raise prices. You're saying that essentially that's not happening.
That's not happening. I mean, there's a limited number of supply and there's an increase in demand, and the companies have to basically meet that demand by increasing prices because of transportation cost, because it's so much harder to get a hold of, numerous reasons, but it's not price gouging.
Well, I think in the past, we've had price controls imposed in economic hard times. Now, the White House isn't really talking about that, but some analysts are speculating all that. Do price controls work?
They do not.
Because
because what you basically do is you cause pent up demand, and then secondly, a lot of companies actually have to operate at losses. I'll give you a perfect example from World War I. In World War I, the government put price controls on like copper and zinc and steel because they needed those products for the war efforts in World War I. So a lot of companies that were manufacturing these products, they actually operated at losses. The only reason they were able to stay in business was because the government was basically pumping money into these companies to buy those products. They just didn't want to buy them at higher prices. And then as soon as World War I was over, the government lifted all the price restrictions, and copper, zinc, and everything shot through the roof like crazy because the factories or the owners of the factories were trying to recoup the money that they didn't make when there was price controls in place.
all right, Mark, we're wrapping up now, but this building behind me, the Federal Reserve, you said before, and this is a topic maybe for the next time, that we'd be better off without the Federal Reserve in terms of the economy staying on an even keel, right?
Correct. Yep.
Okay, that'll be our next topic, including the next
All right.
breakfast. So Mark Collinsworth of Vere Global Financial Wealth Management, thanks once again for being with us in these interesting times. Thanks, Mark.
Glad to be here. Thank you.